Hello friends, welcome to Hemant YouTube channel. Today we are going to learn accounting treatment for equity settled share based payments. The purpose of listening to this class is, for example, after completing your CA final, you enter an interview with Flipkart or some other one, some other company. They have asked one question. We have given some shares to our employees, ESOPs, and how to account that in the books. Then the answer is this video. So this video says how to account equity settled share based payments. Equity settled share based payment means giving ESOPs to the employees or ESPPs to employees. So before entering into the video, let me explain some of the terms which we have learnt in CA Enter and ESOP chapter. First one, grant date. Grant date means, for example, a company has announced to its employee that after 3 years, it is going to give equity shares to its employees, whoever remain in the company. The date of announcement is nothing but the grant date. And the 3-year period is known as vesting period. And the condition is need to be in the company. This is nothing but vesting condition. And after 3 years, the employees can exercise their option, that is exercise date. So grant date is nothing but announcement date of ESOP. And vesting condition means condition need to be satisfied to get the ESOP. And vesting period means the period over which vesting condition needs to be satisfied. Fourth point, exercise date. Exercise date is nothing but where ESOPs can be exercised. So let me explain with an example, simple example. ABC Limited granted to its employee share option of a fair value of 5 lakhs on 1st April 2010 if they remain in the organization up to 31st March 2013. On 31st March 2011, ABC Limited expects only 91% of the employees to remain in the employment. On 31st March 2012, company expects only 89%. And however, in the March 2023, 82% of the employees. So for this is the timeline, and 1/4/2020, 31st March 2023. They said that company is going to give equity shares to its employees of worth of rupees 5 lakhs. So 5 lakhs. So on 21, they expect that 91% of the employees will access. On 22, they expect that 89% of the employees. On 23, only 82% of the employees they are going to access. So there are two things we need to learn here. First, learning how much expense need to be recognized in the books, and second thing is how to account that in the books. So first of all, let me explain how much expense need to be recognized. Here they have given clearly that 5 lakh fair value of option is given to its employees. So 5 lakhs into 91%. They said that for 100 employees, we are going to give 5 lakhs worth of equity shares. So 91% of the employees will access. So 5 lakh into 91%. In the year 1, they will recognize. Wrong. Because if these conditions is satisfied over the period of 3 years, that means the employee is going to give his benefit, his service for 3 years. So this 5 lakh into 91% we have to recognize over 3 years. So 5 lakhs into 91% divided by 3. That much expense need to be recognized in first year. Second year, they said that only 89% of the employees will exercise the option. So 5 lakh into 89% into 2 divided by 3. we'll get how much expense need to be recognized for the first 2 years, and from that we are going to reduce the expense recognized in the first year, and same like that in third year. So this is how much expense need to be recognized. And what is the journal entry for this? What is the journal entry? You only say for normal equity shares, whenever we have given to vendor, what is the journal entry? Vendor account data to equity share capital account. But uh, this we are going to do during excise date. But during grant date, over the period we need to satisfy, we need to pass journal entry, no? Why we are giving this? Because employees are providing service. This is nothing but employee benefit expense account. So we are going to create employee benefit expense account data to SBP reserve, and like that we are going to transfer some amount to SBP reserve, and at excise date we are going to transfer SBP reserve account data to equity share capital account. So let us see. 5 lakhs, as I said, how much expense need to be recognized? 5 lakh into 91% divided by 3, 1,51,667, and 5 lakhs into 89% into 2 by 3. This much expense need to be recognized, and we have recognized 1,51,000 previous year. So 2,96,667 minus 1,51,667 is 1,45,000, and for third year is 5 lakhs into 82% into 3 divided by 3, 4,10,000 we have to recognize, and first 2 years we have recognized 2,96,000. So 4,10,000 minus 2,96,667 is 1,13,333. So journal entry is employee benefit expense account data to SBP reserve. SBP reserve is nothing but share based payment, that is 1,51,667, and in the same period, same journal entry, employee benefit for second year, employee benefit expense account data to SBB reserve account, and for same journal entry for third year also, employee benefit expense account data to SBB reserve. So at the end, we are excise date, we are going to transfer SBB reserve account data to equity share capital account. That's a journal entry, and you have learnt something how to account, but we need some clarifications regarding this. What's the clarification? Suppose a friend came to you and asked, I am a company, I had a company, I have given equity ESOPs to its employees. They said that on 1/4/2010 we have given there, and at that time market price is 10 rupees, and market price is 10 rupees, excess price is 5 rupees, and they expect that on 31st March 2013 market price will become 20 and excess price will be remain same, rupees 5. So he is asking whether to recognize this 20 or whether to recognize this 10 minus 5. What you will say? We have to recognize this value 20. This is nothing but fair value of the grant. In exam they will give fair value of the grant. So first preference will be given to this, and later to this. This is nothing but IP, and first preference will be given to fair value of the grant, and second preference will be given to this intrinsic value, that is 10 minus 5. 5 will be recognized. So this is first clarification. And second, he came to you and asked 1/4/2010, same 31st March 2013 you said that 20 need to be recognized, 20 minus 5, 15 need to be recognized, and he came to you and asked, and suddenly on 11th 1/4/2011 it became 30 rupees. Whether these 30 rupees need to be taken, he's asking you. we recognize 15 over a period of 3 years, but it become 30. That means 30 minus 5, 25 need to be recognized? No. Why 30 need not to be recognized? Why 15 need to be recognized? Because whenever a company, you see any Reliance company has issued equity shares to its some members, irrespective of fair value, in the books it will not be changed. For example, if it has given at 100 rupees, in the books it will be recorded at 100 only. Share that bank account data to share premium account data to equity share capital. It will not take into account any change in fair value subsequently. Suppose it become 2500 now. Will it be recorded in the books? No. That's it. So any subsequent change in the fair value need not be taken while calculating the ESOP. And if you like my video, please subscribe, share, and thank you.